basically was in the farm, but it was okay. Thank you. Okay, Joseph, how was your weekend?
Very fine.
Very fine. Okay, Pius?
I guess not bad.
Not bad. Ulienda Dunda?
Hapana, siku hizi nalala saa 3.
Okay. Okay. So let's start. If you can see my screen, kindly confirm for me on the same. If my screen is visible from your end, kindly confirm. Only Ambrose can see my screen. If you can see it, kindly confirm. Perfect. So in today's class, last week we looked at futures trading and we dived into how to calculate leverage and things like that. So in today's class, we're going to look at the last part of futures trading, or rather day 2 of futures trading. And under this, we are going to look at what we call the risk-reward ratio, how to set up a long and short position on Binance, then live demonstration on how to do futures trading on Binance in case someone doesn't know. I don't want to assume everyone knows. Then creating a professional Binance Futures screenshot. Then lastly, we're going to have practicals on how to avoid liquidation. So let's start. Someone, before we even start, someone to remind us how we said we calculate leverage, which is the formula to calculate the leverage. That's the major thing we covered last week. How to calculate leverage. How did we say we calculate leverage? Which is what is the formula? Leverage is equals what? Someone. Leverage, someone? Leverage. Okay, just to remind you, we talked about, okay, Joseph?
Percentage risk divided by something you see at the bottom of your stop loss.
Yes, that's it. Percentage risk divided, or rather, percentage risk is the risk that you're ready to incur divided by the standard loss. The standard loss is provided on TradingView. We're going to look at that also tonight again. So let's start with the risk-reward ratio. So risk-reward ratio in crypto is, it measures how much a trader stands to lose or risk versus how much they stand to gain in a trade. I repeat that again. How much they stand to lose. Remember the percentage risk that we discussed on leverage, that one. How much are you ready to lose versus how much they stand to gain. That is what we call risk-reward ratio. And no wonder the formula is potential loss divided by the potential profit. Just to give an example so that you can understand, is if you're risking $100 to potentially make $300, then your risk-reward ratio is 1:3. Do not worry about all this because TradingView will automatically calculate for you the risk-reward ratio. But basically, to understand it, it is a measure how much a trader stands to lose versus how much they stand to gain or reward in a trade. So risk-reward ratio tells you how much money you're risking on a trade versus how much you hope to earn. So it helps to plan your trade smartly so you are not risking a lot just to make a little. There's no need to enter a trade of 1:1. You are risking $100 to gain $100, or 1:2. You are risking $100 to get $200. 1:2 can be fairly good, but I'll advise to have a risk-reward ratio of anything above 1:3. And we'll understand why in a few. So think of it like this. You enter a trade and say, I'm okay losing $10, but I want to make 30 out of the reward. So that risk-reward ratio is 1:3. So why does risk-reward ratio matter? It helps to decide if a trade is worth it, number one. And even if you don't win every trade, you can still be profitable in the long run if your rewards are bigger than your losses. And here's a conclusion, just what I've said. Most good traders aim for at least 1:3 or 1:4 and above. So if your risk is always bigger than your reward, you lose money even if you're right half the time. So let's just have a discussion on the same so that you can understand what we're talking about. So here's a setup. We are having, let's assume we are trading, our capital is $100, and you're having 3 setups. We are having BTC, USDT, like I'm having on the charts right now. We are having VET, USDT, and I can see it's almost coming to a trigger, our entry. But anyway, we're having VET, USDT, and last we can decide to have maybe AVAX. We can use this one that we are stopped out. We are stopped out of this trade, so we can also use this one. So let's say in every trade, if you can look at this, let's start with AVAX. If you look at this, you'll see the risk reward ratio right here at the middle. If you can see that, let me try and zoom in. Not that. Let me zoom in. You can see that TradingView will always calculate risk reward ratio for you. If you can see that risk reward ratio 0.8, thumbs up. If you can see that 5.18, so it means our risk reward ratio in this specific setup, this AVAX setup, let me just do that. So our risk reward ratio for AVAX, our risk reward ratio for AVAX is actually 1:5.8. That's what that means. This part right here, risk reward ratio 5.18, it means our risk reward ratio is 1:5.18. So let's interpret this and see what we mean by this. Let's say our account size, or rather the margin, we call this the margin. What do you say that is the difference between margin and size? Someone? We discussed that. Margin and size. Pius?
Size is the total amount of money in your futures account, while margin is the specific amount that you enter it into a trade.
Yes, the specific, you're very correct on the margin. Margin is basically the capital that you want to enter into a trade, but on size, there's something you're missing out. There's something very important that you're missing out. What do we say size is? Someone? Joseph?
Margin x leverage.
Yes, margin multiplied by the leverage. Let's appreciate Pius and Joseph. Guys, let's appreciate Pius and Joseph. Yeah, perfect. So basically, size is leverage multiplied by margin, but margin is the specific, or rather the capital that you're entering a specific trade with. But in this part right here, the word account size, do not interpret it as leverage times margin, but just interpret it as the leverage, the margin itself. So let's assume our capital is $100 in this trade, and we are risking, let's say 5%. So, okay. So what we are saying is, so that you can see, we are basically risking $5 to potentially get $29. If you can see that, $5. So if you divide 29 divided by 5, what's that amount? Let me just calculate. 29 divided by 5. 5.8. If you have gotten that, thumbs up. 29. If you have figured out how we've done that, basically, let me repeat again. We are our account size is $100, and you are seeing if you tap the take profit, the amount that will remain in our account is $129.02. So basically, the profit that you have made is $29.02. But what you have risked how much? Only $5. $5. You can see the amount. If our stop loss gets hit, then what we potentially get in our account is $95. So basically, we are risking $5 to get what? $29. A fair risk reward ratio is that easy. $5 for $29, a very big margin. So That's our first scenario. Let's go to our next scenario, like right here. I want us to understand why risk-reward ratio is very important. So we are having this trade right here. I want it to have the same condition. $100, our account says right here $100. Then we are risking $5 again. But you can see in this trade, our risk-reward, someone to tell us our risk-reward ratio in this specific trade. What's our risk-reward ratio in this particular trade? What's our risk-reward ratio in this particular trade? What's our risk-reward ratio in this particular trade? Only Pius has an idea. Okay, Pius, let's go.
4.08.
Yes, 4.08. We can see it from this part right here. Risk-reward ratio, 4.08. So it means our risk-reward ratio is actually 1. Risk-reward ratio is actually 1:4.08. And what does this mean? We are risking, again, you can see, we are having $100. I want a uniform setup. We are risking 5%. So as you are risking 5% in this trade, it means basically we are risking $5 to get what? $20. $5 to get $20. So if you take 20 divided by 5, then you'll get that our risk reward ratio is 4:8. You are risking $5 to get $20. That's our second setup. Our second setup like that. Let's go to our third setup right here. And you can see all the setups. Risk reward ratio is everything above 1:3. Let's look at this other one. Also the same setups. I want to risk 5%. 5% again. So what's our risk reward ratio? Someone else who is not Pius. What's our risk reward ratio in this setup? What's our risk reward ratio in this setup? Paul?
6.98.
Yes, 6.98. So our risk reward ratio in this setup is 6.98. 6.98. So let's interpret that. So what are we saying? We are risking $5. You can see that if our stop loss gets hit, the amount that will remain in our account is $95. So basically we'll be at a loss of $5. But if our take profit gets hit, then you are making a profit of what? 34.91. So if you take that 4.91 divided by 5, you get our risk reward ratio is 6.98. So let's look at the advantages of what? Of a good risk reward ratio. So our first setup, which is VET, let me just write here. Our first setup VET, if our take profit is hit, how much will we make? $34. Let me even ignore the decimal points. $34. That's our first setup. Then our second setup was on BTC. If our take profit is hit, how much do we make? $20. $20 on our second setup. Let me just do that. On BTC, we're making $20. Was it $20? Just forgotten. Yes, $20. We make $20 on that same setup. So $20. Then our third setup is on AVAX right there. So if our take profit is hit, how much do we make on AVAX? $29. So 29 right here. These are conditions if we make profit. Right here, these ones, if we make profit. If we make losses, how much are we losing in each trade if our stop loss is hit? Someone? If our stop loss is hit, how much are we losing? Someone? Joseph?
$5.
Why $5? You're correct, but why $5?
That's the risk.
Yes, that's the risk we took. Remember, let's appreciate Joseph. Remember we said that if you come to this setup right here, This is the condition that we put, that our risk is 5% of our account. So 5% of $100 is basically $5. So we are losing $5. So I want us to do something so that you can understand why proper risk reward ratio or bigger risk reward ratio are over advantage. So let's say we only win one trade, only one trade. So we say we've won this trade, we've won this first trade, so we are having $34, but we have lost the rest. How much profit or loss will we have made? Someone? We win only VAT setup alone, but we lose the next two. How much will we be at a profit or a loss? And if so, how much profit or how much loss? Let's have Pius.
We will be on profit.
Of how many dollars?
It will be 34 minus 10, so 24.
Yes, we'll be at a profit of $24. So we have said we are winning VAT. Remember, this first line is for wins. This second row is for losses. So if you win on VAT, then you've made a profit of $34, but we've lost on the rest. So we have lost $5 on BTC, $5 on AVAX. So it means the total profit that we'll have made in that day is 34 minus our 5 loss, the first loss, minus our second loss. So basically we are having a profit of $24. So also the same, the inverse is the same. If I win 2 and I lose 1 trade, I win VAT and I win BTC and I lose AVAX, how much profit will I be sitting at? Someone? I win the first 2, VAT, BTC, and I lose AVAX. How much profit will I be sitting at? How much profit will I be sitting at? I win VAT, I win BTC, but I lose on AVAX. How much profit will I be sitting at? Joseph? Okay.
$9.
I wanted someone else. Okay. Let me see who is here also. Waingo, let's go. How much profit will we have made? Waingo, your hand is up.
That will be 54.
$54.
$54.
I win VAT, I win BTC, but I lose on AVAX. Overall, what's my profit?
That is 54 minus 5.
Exactly, 54 minus 5. Let's appreciate Waingo. 54 minus
It's
5.
Mula Mula, by the way.
Oh, it's
That's
Mula
my
Mula.
other.
Oh, you're in another
Yes.
email.
Yes.
Okay, perfect.
Literally, you have to have many emails, otherwise you will see fire.
Yes, very advisable. So, okay, so our profit, our overall profit will be $49. So let's have a scenario where you are having a risk reward ratio of maybe 1:1. 1:1. Let's say we are having 1:1. So that you can see the difference, why we are saying having a good risk reward ratio is very important and very vital, because if you lose, it will make sure that even if you lose 3 trades in a row, that one single trade will cover everything, will cover your losses, and also you'll have profit on the same setups. Let's have a scenario where you're having 1:1. Basically, if you say you're having 1:1 is when you're having a setup like this. Or let's say even 1:2. Let me see, 1:2. There, 1:2. So it means I'm risking $5 to get what? $10. Okay, $5 to get $10. So this on VAT, I'm risking $5 to get $10. So the first setup on VAT, this second scenario, let me have some dash. So if I win it, I get $10, but if I lose $5. Let's go to our next one, which is BTC. 1:2 also. 1:2 right there. So also I'm risking $5 to get also $10. $5 to get $10. Perfect. So just the same, I'll come to this part. I'm risking $5 to get $10. No, I'm $10. My risk is 5. Let me just use the same format. And also the same on AVAX will be the same. $10 to lose 5. So that's a risk reward ratio of 1:2. So someone to tell us, if I win on VET alone and I lose both of these, how much profit or loss will I have made? I win only the first setup, which is VET, but I lose the setup on BTC and AVAX. How much profit or loss will I have made? Pius?
A loss of $5.
A loss of $5. Why?
Because the first trade was successful, while the other two you lost. So it means that you lost $10 and you won $5.
Let me rephrase this so that we can do together with you, Pius. I've won VET trade. So if I've won VET trade, how much money have I made, Pius?
$10.
$10. Perfect. But on BTC, I've lost. How much have I lost?
$5.
Okay, perfect. And on AVAX, I've lost. How much have I lost?
$5.
So how much money do I have? Profit.
Neutral.
Exactly, neutral. I made $10 on my first setup, but I consequently lost on BTC $5 and on AVAX $5. So basically what you are saying, that day, I didn't earn anything. The money I started with is the money that I ended with. So if you've gotten the idea of having a larger risk-reward ratio, thumbs up. 1:3 and above. That's the way to do it. Have 1:3 and above. And no wonder when you're coming back to our slides right here, you'll see it helps you to decide if a trade is worth it. If, for example, you've done a setup, you've done everything to justify that setup, and your take profit is around here and your entry is around here, but if you see your risk reward ratio is 1:2, it's better to leave that setup alone. Leave it, you'll come and find a proper setup that has a risk reward ratio of something like this, a larger risk reward ratio. So it helps you decide if a trade is worth it. If the risk reward ratio is less, then you can decide to ignore that. Then, even if you don't win every trade, you can still be profitable in the long run if your rewards are bigger than your losses. Sly, you have a question?
Yes, I have a question I wanted to ask you. Sorry, which tool is that you're using to do risk reward ratio with?
Position tool, the normal position tool.
Okay.
This one right here. If it's a long position, this one, let me just use one. If it's a long position, you'll see it will calculate for me, even if I'm not on the charts right here. You can see this is a long position. My entry, my stop loss, my take profit will give you all this, the risk reward ratio. If it is a short position, you also like that. It will still calculate for you.
So if you are saying it is the risk ratio is 1:2, you ignore that.
Yes, basically that's what I do myself. Is if my risk reward ratio is less, it doesn't make sense. I can't be risking $100 to get $200. At least my risk reward ratio should be higher, so that it means, for example, if this 1:6, it means if I risk $100, I'm risking $100 to get $600. So it makes sense.
Okay.
You've gotten the whole idea.
Yeah, because I think that's the mess that I've been doing. I make money, then I start losing slowly.
Yes, with an improper risk reward ratio, you can make a lot of money today, but two losses, consecutive two losses, will wipe out all your profits. So it's better to have a risk reward ratio of 1:3 and above.
Okay, thank you. Yeah.
So you can see most good trades aim for at least 1:3, 1:4 and above. If your risk is always bigger than your reward, you lose money even if you're right half the time. So yeah, that's all about it. Why is risk reward ratio matters? I think this we have covered in the midst of us discussing that. It protects your capital, number one, self-explanatory. It supports discipline, so it encourages traders to only take trades where the risk reward, or rather the reward outweighs the risk. We have looked at that already. Works with win rate. Even a 30% win rate can be profitable with good risk reward ratio. Then it reduces emotional trading. When risk reward ratio is planned, there's less panic and less revenge trading. Someone tell us what revenge trading is, or to just give us a guess. What do we mean by revenge trading? And how does RRR reduce revenge trading? Let me see who is here. Waingo, let's go. Mula, sorry. Let's go.
When you revenge trade, you want to keep on going back to recover, to try to recover what you have lost.
Exactly.
But
That's
you'll keep on losing.
So how do you think risk reward ratio helps reduce revenge trading?
It will help you whereby you aim to get more and you risk less.
Yes, basically that's it. So with a proper good risk reward ratio, you'll have less panic and you will not revenge trade, because you know it will only take you one win trade for you to recover all your losses and actually have profit on top of recovering your losses. So let's go to this part, how risk reward ratio reduces risk. We have done this already. It foresees risk planning, prevents large losses, improves your consistency, and works with stop loss and discipline. So all this you've done so far. So tips for using risk reward ratio: always define your RRR before opening a position. We've done that. Said if your risk reward ratio is 1:2, it's better to ignore that, but 1:3 and above, perfect. So use limit orders and stop losses to automate execution. This we all know. Then avoid chasing trades with poor RR, even if they look good. Even if you see for sure this trade will go this way, but the risk reward ratio is 1:1, it's better to leave it. Doesn't make sense. Then combine RRR with technical analysis for better accuracy. So that we've done already. So with risk reward ratio, you don't need to win every trade. You need to manage every trade. So consistent use of risk reward ratio is one of the best successful habits in crypto futures trading. And you've looked at how that works. I think this I've done already. Sly, you have a question?
I do. So I've just done one short position. And the ratio in Anyambia 1. So that means that that's a bad trade.
Yes. It means you're risking $10 to get $10. That's a risk reward ratio of 1:1.
So you say if it's 1:3 is better.
Yes, 1:3 and above. 1:3, 1:4, 1:2, 1:1 doesn't make sense.
Thank you. Yeah, I think that's why I was, because now today I made good money. Then now I'm losing all the time, and now I'm not where the problem is.
Yes, it's risk reward ratio. It just takes one trade only, you recover everything.
Why is those people are laughing at me? Those Joseph.
Yeah, but anyway, now you get the concept.
I do. Thank you.
Yes, perfect. So the other part is a practical demonstration on futures trading, because I think this we've done already on trading view on risk reward ratio. We've done that. So let's look at practical demonstration on trading futures. So before you even go to futures, there are things that we need to understand. And let me use this setup because it has not been triggered yet. So we can use this setup right here. Let me delete all these and assume this is our setup right here. I want to basically describe, or rather indicate, how we open positions in futures. I don't want to assume everyone knows. So the number one thing before you even go to your charts and determine an entry, the number one thing is to come on your trading view. do your analysis. We have done this. These stop hunt, change of character, stop hunt, change of character. Just basically analyze your chart. Have an entry right here. You can see our entry is 0.26833 from this far end right here, or basically where this green line is. That's our entry. Let me even name it. Here's our entry. Let me move it to the right. Yeah, we're having our entry right there. Let me define everything. You're having our stop loss. Let me have that in red and name it stop loss, a sell, like that. We are having our stop loss right there. Then we are having our take profits, TP right here. So after determining your entry, we have our entry, we have our stop loss, and we have our take profits. The next thing that you need to check is our risk-reward ratio. Is our risk-reward ratio, is our risk-reward ratio a good risk-reward ratio? Someone to tell us. Is our risk-reward ratio a proper risk-reward ratio? Let me zoom in. Like that. Is our risk-reward ratio a proper risk-reward ratio or not? Sly, tell us.
I think 7 is to 0. 7 is to the ratio is 7 is to 0.2. I think it's good.
It's actually good, but you've interpreted that wrongly. Someone to tell us what's our ratio? What's our ratio with this setup?
1:7.
Yes, 1:7.02. Is that okay, Sly? The one is invisible, but always know there's a 1 there before.
Okay.
So if I'm having $10, Sly, what's my risk? What's my reward? I'm risking $10 to get what? If my risk reward ratio is 1:7.
To get 7.
I'm risking $10 to get what?
70. No?
Yes, $70. Yeah. And if I'm risking 1 Kenya shillings, I'm getting
$7.
7 Kenya shillings. Okay, but
7 Kenya shillings.
Yes, it's 7 Kenya shillings. Now you've understood the concept.
Yes.
Yes, so our risk reward ratio right here is 1:7. So our second checklist, done. We have our entry, we have our stop loss, we have our take profit. Our risk reward ratio is correct. What else do we need to do? We need to calculate our leverage. That's the third thing. The first thing, have your position, entry, stop loss, take profit. Second thing, your risk reward ratio. Is it a good risk reward ratio? If it's 1:3 and above, perfect. So this one falls within our perfect risk reward ratio because it's a ratio above 1:3. So it's 1:7. So tick on that. Then the third thing that you need to do is our leverage. And how do we do that? Even before you get to leverage, determine the amount of capital that you want to put in this trade. Let's use 100. Let's use 100 for the knee. Then determine what's your risk. How much are you willing to risk in that specific trade? How much of your capital are you ready to risk in that particular trade? If it's 5%, then it means you're ready to risk 5% of the $100. Remember, our account size is $100. So 5% of $100 is $5. So you're ready to risk $5. If you want to risk $10, then it means you are risking 10% of our account. So 10% of $100 is $10. Let's work with, we are risking $10. So if you are risking $10, then it means now we are having those conditions. If you've input our risk, we have input our margin, which is our account size in this scenario, our account size, and there we are good to go. So the last thing that you are remaining, our fourth checklist that you are remaining to do is know our leverage. And remember, we said that leverage is equals to percentage risk. Where is equals? Is equals to percentage risk divided by what? Standard loss. Standard loss, like that. Let me just move this to that. So it means our leverage right here in this scenario, our leverage will be, what's our percentage risk? We've just input that right here. The risk that you're ready to incur. What's our percentage risk? What's our percentage risk in this scenario? Joseph?
5%.
5%. Let me go back. That was our first risk before. What's our risk, Joseph?
10%.
Yes, 10%. This one right here. Our risk is 10%. So we are having 10% divided by, where is our standard loss? Someone, where do we get our standard loss? Where do we get our standard loss? We did that last week. Where do we get our standard loss? Pius.
I'm not sure.
Not sure. Sly. Where's our standard loss?
Please help me. I think I haven't watched that class.
Okay, let me just help you. Our standard loss, move your cursor to this part. We're at the bottom of our screen, where if you can see stop 0.00535,537. If you can see that, what's the value in brackets? That's our standard loss. Someone. We have stop, then 0.00537, then you have a value in brackets, then 537, then amount 90. That's our standard loss, the value in brackets. What's our value there? Someone?
2%.
Yes, 2. So divide by 2. So what's our leverage now? 5x. Perfect. So after determining all that.
So R you said is the amount we are ready to lose.
Yes, the amount you are ready to lose. This one. Remember, you're risking 10% of my account. So what's 10% of $100, Sly?
It's 10.
$10. Exactly. No wonder when you come to this position, you see, if your take profit is, if your stop loss is hit, how much will remain in your account? $90. You can see there $90.
Yes.
So how much money have you lost? Remember, your starting capital was 100.
$10.
$10. But if our take profit is hit, how much will be in our account?
110.
110.
Sorry. Yeah, because if the stop loss is hard, we get 90. Understand? If take profit is taken, then we have 10 times 5, 150. What am I saying?
Together. Let me just explain for you. What's our risk-reward ratio, Sly? We're going to go step by step. What's our risk-reward ratio?
1:7.
So if I risk 1 Kenya shillings, how much will I get?
7.
7 bob, right?
Yeah.
That's the same thing. So right here, I'm risking $10. Right?
Yes.
Because we are risking 10% of our account. So $10. So how much will I get? Take profit.
So am I supposed to use 10 times 7?
Exactly. Because remember that example, our risk reward ratio is 1:7. If I risk 1 bob, I'm going to get 7 bob. So if I risk $10, what am I going to get? $70.
Okay.
You've gotten it?
Yes.
But instead of tiring your brain, TradingView, or rather this position tool, will calculate that for you. And that's why I was telling you, if I move my cursor to this, it will calculate for me the risk-reward ratio, that is 1:7.02. And it will also calculate for me how much I will lose. If I hit my stop loss, then the amount that will remain in my account is right here, $90. You can see that part?
Yes.
90. So the amount that will remain in my account is 90. So how much loss have I undergone? 100 minus 90. So $10. Is that okay?
Yes.
But if I hit my take profit, how much money will be in my account? It's right above there,
170.
But my starting capital was $100. So 170.22 minus $100.
170.
Yes, 70.22. Is that simple? Are we okay now?
Yes.
Yes. So we have everything that we need. So after having everything that you need, what do? Go to your Binance account. Here's my Binance account. Remember what you said? This is the part where you choose the coin that you want. So go to VET.
Excuse me, madam.
Uh-huh.
I was not keen on the tool you are using. So please could you indicate which tool and which tool you use to indicate to calculate the tool. Which one?
Which tool? This tool.
Yeah.
Is the long position tool. Long position tool. This one right here. Let me just delete. Long position tool. You get it from this part. We are having a long, in case it's a long position tool, a long setup or a buy setup. This one right here. It will calculate for you.
Okay.
Yes, if it's a short position, just come to a short position. Where is it? Short position, and it will do the same for you.
Perfect.
Yes, it will calculate for you. So going back to this, we have everything that we need. Number one, come to your Binance account, choose the token that you want from this part. If it was BTC, come to this part, BTC USDT, and just pick it, USDT, like that, and pick it perpetual. But in this case, we are having VET. We are having VET USDT, like that. So choose VET USDT. I'm going to close. I have an open order right here. I'm going to close it so that you can have some amount on our Binance. Bas, I've cancelled it. So I'm having VET USDT. That's point number one. Number two, come to this part. We said, what's the best margin to choose? Isolated or cross?
Isolated.
Isolated. So choose isolated. And if you don't remember the reasons why we are not gonna mention here, go back to our previous video and you'll be able to understand why you use isolated and not cross margin. So our leverage, we calculated our leverage right here, and our leverage was basically 5x. So from this part, you can come use the cross fader right here to choose your leverage, or you can manually input it right here. Just say 5x. Our leverage is 5x, or just come or increase it using this plus sign or minus here, or use this crossfader. Any that you want, you can choose from that side part and say what? Confirm 5x. Then we are having our price, our entry price. Remember, we have that right here. Our entry was in red, was in green rather, and it was 26,833. If you see that, thumbs up, 26,833. This part right here, 0.26833. Perfect. So that's our entry, 0.26833. Our size, someone to tell us what our size will be. Remember, the margin that you intend to use is $100, and our account has $147.
But Wanjiko, before we proceed,
Okay.
I'm still having a challenge of putting that long position. If you don't mind, demonstrate it again, like how, like let's say for example, we know, like now we know our entry point. Let's say for example, we want, I'm not able to see, just wait. I'm trying to zoom into my whatever. Let's say like now the entry point is 0.022633. So you have to adjust the stop by yourself, or it detects itself by itself.
No, you have to adjust. You're the one who is doing an analysis. You can see mine. I didn't put it here because once I did my analysis, I decided my take profit is gonna be at this part right here. So I adjust it on my own. No wonder I was saying, if you do a setup and you have your take profit, for example, right here, and if you put your position tool, you see that the risk reward ratio is 1:2. Ignore that setup and wait for when you'll have a proper setup that has a good risk reward ratio. So remember, when I was doing this setup, I didn't know myself what the risk reward ratio will be. I just determined my entry and my take profit and my stop loss. So coming to this adjusting, it will calculate for me my risk reward ratio.
Okay.
Is that okay?
Yes, thank you.
Okay, going back to this, we have our entry right here. Then we are on the size. How much do you think we should put on our size? Let's start here. What size? What's the size? What do you mean by size?
The amount you want to risk, maybe $10.
Not quite there. Not quite there. We've mentioned it right now. What do you mean by size? Pius, you had answered that wrongly, so I want you to answer this correctly. Pius, what did I tell you a few minutes ago?
Margin times your leverage.
Margin times your leverage. And what's our margin?
100.
Yes, 100.
Or 10.
That's what we had determined. Our margin is right here, $100. We want this trade to use $100. So what we'll do now, 100 times 5, right here. So the amount that we'll use right here is 500. And you'll notice after putting 500, you'll notice that the amount, you can see our balance right here was 147. So what amount will remain in our account once we click OK? What amount will remain in our account? Ambrose, what amount will remain in our account? We have input $500, but we don't have $500 right here. How much will remain in our account?
I thought you only pick, it's picking $100 from there. So $47 remain?
Yes, perfect. 47 will remain. Remember leverage, using 5 leverage, basically what we mean, we want to trade with $500, but I only have 100. So I'm basically telling Binance, borrow me or lend me $400 on top. No, and I'm losing a 5x leverage. 5x leverage, so 500. So the amount that will remain in my account is $47. 500, or you can use this crossfader. But it's good to input the value itself to be very, very precise and on point. Then we have our take profit. Coming back to our chart, our take profit was 30,584. 30,584. So 0.03584. Then our stop loss is what? Our stop loss, you can see it from this part, stop loss 26,282. 26,282. So 0 point. Let me just 0.0.
No.
What have I done? 0.026.
Your comp is misbehaving.
0.026. 26 what?
282.
282. Yeah. 282. Like that. Then it's a long position. Remember, we said a long position is a position that's going up. Is going up. So because it's a long position, then we click what? Buy long. So after clicking buy long, you'll notice it will come to the open orders, not the position. Open orders. Why do you think it's not under open under position but under open orders?
Because it has not been reached.
Yes.
Pending.
Who has answered that? I've had pending, has not been reached, has not been triggered. But all the 3 answers are correct. It has not been reached, it has not been triggered, it has not been, it's under open. So where do you think it has gone? Where did you say open orders are kept or pending orders are kept? Where do the open orders go or the pending orders? Pius.
Order book.
The order book, this part right here. The order book. Order book is where all pending orders are kept. So our pending order, well, let's interpret this. So it says we have opened a position this time on this pair using a limit, a buy limit. So, and our price is that, our amount is that, this is inclusive of the leverage. Then field 00 because it's not been triggered and stuff like that. So what this means is that when price, when VET goes down up to this part, where's this arrow? If VET goes up to this entry, then we'll be triggered into that trade. If it goes all the way up to this, we'll be stopped out. But if it goes like this, we'll go all the way to our take profit. That's the first part. So I want us to see how it looks once it has been triggered. So for me to do that, I'll basically do what? And you can see the balance that remained is $47. So it's basically $100 only from our account has been used. But I want to show you how a triggered position looks like. It will not come to the open orders because of the open orders is where pending orders are kept. But Mula, kindly mute yourself, mute your mic. So the pending orders will come from this part right here. Let me just mute for you. Great. So all pending orders will come under the open orders. All the orders that have not been triggered will come under the open orders. But I want to show us how positions or open orders or orders that have been triggered look like. So let me just cancel this. I'll cancel this like that. Then you can have our $100 back here. I hope you've seen how you cancel it. Just click there. It has already been cancelled. Let me just refresh. Let's wait for it to refresh. Perfect. Our $100 is back. So I want us to open this, or rather to have a demonstration of how triggered positions look like. So I'll use the market order type. So it means I've entered using the current market price. Then our size is 500. I want to use $100. Our take profit was 0.03 something. 3584. Our stop loss was 0.02282, if I'm not wrong. Or 26 to 82. Like that. And I'll say buy long. So it will be executed immediately because we are using the buy limit. Oh, not the buy limit, the market order type. So in this scenario, now it has come under the positions. Why am I having an open order? Oh, okay, yeah. So I'm having one position, an open position that's currently running. So we are having the size 599, which is margin times our leverage, which is 5x. Then our entry, our break-even price, our market price or the current market price, our liquidation. What do you think? What does this mean, liquidation price? It means that once VET goes down to this price, then all my amount, all my $100 will be lost in that setup. But do you think I'll lose that? No, I won't lose that because I have a stop loss. And the stop loss will basically ensure I'll be stopped out before I even get to this liquidation price. Then you're having our margin ratio, then our margin, the margin that we've risked into this trade, that's $100. Then this is where we have our P&L. So far, we are on $96 up, $0.96 up. That is 0.99% up. And this is basically the screenshots that you see. Someone comes to this part, and you can see this. If you've been seeing this screenshot somewhere, thumbs up. Exactly. So it says you are trading on Binance. It's a long position. You're not shorting the market, you're longing. It's on 5x leverage. This is my leverage. The pair I'm trading is that. Then the current percentage profit, the ROE, the return on investment is 0.44%, but the profit that I've made in USDT, or rather in dollars, I've made $0.58. My entry price was that, my last price of that, and this is my referral code. I'm having that name right there, and the timestamp at this part that is inclusive of even the date. So if I don't want people to see my leverage, I can hide it from that part. If I don't want people to see my P&L amount, I can hide that. If I don't want people to see my entry and my exit prices, I can hide that from that. But it's good to always have that, at least the leverage and the price like that. Or even the P&L if you're comfortable sharing that. So that's all about it. But you'll find people have this place as numbers, 8 point something. Let me just show you from these. I basically use slice image from today, you'll see having a professional look is having something like this, Sylvia Washira, or something like Engineer Wanjiko. Instead of having something like this, it looks less professional. If you agree to that, if you agree this looks less professional, thumbs up. Exactly. So if you want to change that so that it can be, you can look at least professional, what you do, just come to this part right here, this one right here. Then go to referral, like that. Then after going to referral, you'll see this part written invite now. You're being told to invite friends to Binance Futures. So just go to invite now. Then what you do, you can change it. You can see this part written customize code. If you can see that, thumbs up, customize code. You can customize your code right here. I can basically call this KCM to stand for Kenya Crypto Magazine, like that. And I say confirm. But I don't want to change this. It will tell, anyway, confirm. Perfect. So once I've confirmed, I'll say yes, and that's it. So if I go back now to my futures, you'll notice something. If I want to share this, you'll see. If I want to share this, then it has not changed. Maybe anyway, but basically that's where you change that. Let me just do that again. Pius, you've seen I've done a mistake.
Yeah, they said that username is already in use.
Oh, it's already in use.
Yeah.
So basically what you do, take a name that is easy to, or rather has not been used. You can customize that from that part right there. I hope that part is clear. To basically make sure it looks more professional. So any question before we cover the last part of this class? Any question?
How do we do trailing stop?
Trading stop, what do you mean?
Trailing stop. Trailing stop.
A trailing stop loss does not even work on Binance Futures.
Okay,
It only
but
works on the spot market. But I'll record that and I'll share with you. It works on the spot market. If it works on the futures, hey, Binance will be losing a lot of money. They cannot allow such a feature there.
because it accumulates for you as you gain.
Yes.
Somebody told me it works. I mean, it does on Bybit. Somebody has checked.
It works on?
Bybit.
Probably. I'll check. I don't know about Bybit. I only trade on Binance, Mexi, and KuCoin mostly.
Okay.
Joseph?
I have a question.
Okay.
If, let us say you are scalping and you are on P&L of plus, let us say 10%.
Mm-hmm.
If you click on the cancel trade, will it cancel with that and realize P&L to realize profit?
Exactly. You have done a very good to mention that. Let me just, I even forgotten that about realized and unrealized. So let's do even that practically, what you've asked right now. So what Joseph is asking is, I don't know how to rephrase that, but let me explain using this, then you'll be able to catch through my explanation. So if you look at this right now, we are sitting at a profit of $80. 80, but it keeps on changing because this is unrealized. By unrealized, we mean that that money is not yet in your wallet. It is in the market. So it keeps on fluctuating depending on how the market is moving. So right now we are at $78. So if you want to collect this profit manually without even getting to take profit, remember if the market gets to my take profit, you can see that it opened two open orders. The first one is the sell, and the second one is also the take profit. One is the stop loss. The second one is the take profit. So if I get to my take profit, I'll make my money. If it hits my stop loss, then I'll lose that specific money. So what if I want to close? I don't want to wait this market to get to my take profit. What will I do to make this profit realized, or rather to go into my wallet? Remember, we started with $147. I hope you can remember that. So if I want to close for me to get this profit, what I can do is just close. Come to this part and hit close. Close all positions. Close with the market price. And I'll close it like that. Close at market. I've clicked that. And it has basically disappeared. And now my profit has, remember I started with 147. So that $0.78 is the profit that I've made. Now that money is in my wallet. I've made $0.78. Is that okay, Joseph, now?
Yeah.
Yes. Basically, that is what Joseph was asking. So going to our last part of this class was how to avoid liquidation. And by liquidation, we mean being wiped clean of your trading accounts. So, number one, use low leverage. So having a low leverage will do what? We'll have more breathing room. This is what we mean by more breathing room. Let me do that again. So we are having the same pair. Then we're going to enter at market. Let's lose $50. So 5 times 50 to 50. I want us to use $5. $50. What's 50 times 5? To 50. Yeah, I'm correct. To 50. Let's even assume our take profit and our stop loss. Let's just assume. Let's buy long. So you will notice with a low leverage of $5, our liquidation price, let me just write here, with 5x leverage, with 5x leverage, with 5x leverage, with 5x, our liquidation price is quite far, is 0 to 24. What's this amount? Let me just copy it. Copy our liquidation price is that. Right there. That's our liquidation price. So let's look at our liquidation price when it comes to maybe a bigger leverage. Let me close that. Close at market. Then you can redo the same, but this time round, have our leverage at maybe 10x. Confirm. Then we can do another to 50 again and buy long. So with that 10x leverage, what is our liquidation price? Our liquidation price is what? That one right there. With 10x, our liquidation is that. And you can see. So basically what this means, let me move this all the way so we can see that practically. With our 5x leverage, our liquidation price is at this price right here. Let me delete that and set this to what? This is our liquidation price. I want us to see this. Our coordinates is this price right here. So that's our liquidation. That's our first liquidation. Let me have that in maybe a different color, blue. So what this means is, with our 5x leverage, the market for the market to wipe us clean, it has to go up to this price right there with 5x leverage. But with 10x leverage, what's our liquidation? Our liquidation is this. Copy. Let me draw a line. No, this one. A line, and I'll have my coordinates as that. Like that. Let's have that color, maybe purple or yellow, like that. So for our liquidation, for us to be wiped clean, then our liquidation has to come, our price rather has to come from this price up to this price. You can see now with a high leverage, our liquidation price is quite near. In comparison to a low leverage, our liquidation is down here to the green line. So it means our market, our chart or our setup has a lot of breathing space. But because as we are safe traders, we have our stop loss right here where we're having our red. So we don't even have to get all the way to our liquidation price right here to lose all our $100. For us, once market taps right here, we lose our $5 and we are done. Let me just close this before I get liquidated. Market like that. So that's our first scenario. That's how using low leverage will reduce your liquidation. Sly?
Yeah, so I wanted to ask you, so how do you determine a stop loss? Like, because that's another area that I struggle with. Like,
Okay, we'll do that tomorrow. Do not worry. Hold on to that question. We'll do that tomorrow.
All right.
Then the second way to avoid liquidation is to actually set a stop loss. And that I've explained as I was explaining this. Having a stop loss is that even you don't need to get all the way to your liquidation price. Your market will be stopped at this entry, at this point right here, at your stop loss, this part. Once market taps this red line, your stop loss, remember, it's our stop loss, then you'll be stopped out of that trade. So you don't need to struggle that quite much or worry about being liquidated. Where's my slide? Yeah. Then the third way to avoid liquidation is what you call DCA, and the fourth one is what you call the add margin. So let's look at those two setups. So same thing. I don't know even why I closed this. Let's reduce this to 5x again. Enter with market, and we'll say to 50 again, to 50. Remember not to open a position without taking, or rather inputting your take profit and stop loss. But because this is basically a demonstration, what you'll do, I'll just say buy long. With those two conditions, what you'll notice, my liquidation is 220. Let me even write that down. My liquidation is 220. 220. Let me write it. Let me actually send it in the group. My liquidation right here, liquidation is 0.0220, like that. Right here. This is my liquidation price right here. But you have been told if I want to lower my liquidation, then what I do, I DCA. What do we mean by DCA? Opening the same trade with the same leverage and conditions. So what I'll do, remember I have $97 in my account. I want to lower my leverage to make it lower. Remember, we have my margin as $50, but my size is 250 because leverage, because size is equals to margin times my leverage, which is 5x. That brings it to $250. These are very important points. My size, my liquidation price, and my margin. My margin right here. So let's start with DCA. DCA means you open the same trade. You open the same trade of the trade that you want to lower its liquidation. In this case, I want to lower my VET liquidation price. So what I'll do, I'll come to this part with the same condition, VET USDT 5x leverage. I'll open the same trade with another $50 to $50, and let's notice what will change in the market. And I'll say buy long. So what will happen? What will happen is my liquidation price has been lowered. It was 220.45. Now it has gone to 0.022035. So it has moved from 0.45 to 0.35. If you have noticed that, thumbs up. Perfect. What's the advantage of actually DCAing? What's the advantage of DCAing? What else has changed? My margin has changed. My margin has now increased to $100. Have you seen that? It was $50. What has changed? My margin has increased to $100. If you've seen that, thumbs up. $100. Perfect. So with my margin having increased, it means I'll now be benefiting from those specific profits. Remember the first setup, I was only benefiting from a margin of $50. But with DCAing, I'll also benefit from increasing my margin. My margin has increased to $100. What else we forgot to put in is that it also lowers your entry price. I just forgot for us to register what our entry price is. So it also lowers your entry price. And it lowering your entry price, it means you're also benefiting more. You are making more profit on that particular trade. So that's all about the DCA. The DCA. And what's the difference between DCAing and now adding margin? You can see DCAing is to add to a position slowly, not at once, what you've done, opening the same position. But with adding margin, you boost your available funds to reduce the liquidation risk. So let me just close this setup and redo again. We'll see how adding margin works. So close at market like that and reopen again. I want to reopen this again. So I'll say market, then to 50. I'll just add to 50 again. And remember to always have your take profit and your stop loss and have a buy long. So we are having our liquidation price at 0.41. So if I want to lower this liquidation, what I do, I come to this part and add my margin. Add my margin from this part right here. And say, I want to add another $50 to that particular trade. I say confirm. Let me just remember again, it was 0.41. So let's see if that changes. $50. I want to add $50 like that. And I say confirm. So once I've said confirm, you'll notice, what's our liquidation price?
Down.
0.01.
Yes, it has
0.01
down. Yes, it has moved far down. So the advantages of adding margin is that your liquidation price moves very far. If you've noticed with DCA, we DCA'd with the same value, which is $50, but our liquidation price was quite low. If you can remember, we moved from 0.45 to 0.35, right?
Hello?
Yeah.
So basically, what we mean, what we are saying is, with the DCAing, yes, your liquidation price will go down, but it will not go far down. But the benefit of DCAing is that it will lower your entry price. And once your entry price has lowered, it means also your profits will increase, will be more. It will determine even on that. But with the adding margin, yes, your liquidation price will go far down, but your entry price will remain unchanged. So the profit that you are making initially with the initial $50 that you had, that's the only profit will withstand. The extra $50 that you've added here as margin will just be there to withstand, or rather to only and solely lower your liquidation price. It doesn't do any other thing. It lowers your liquidation price and that's it. But the profit that you'll make, it will be solely on the initial margin that you had right here, which was $50, which is not the case with DCA. DCAing, it lowers your entry and the margin that you've added will be included when counting your profit. I hope that's okay. Any question? Let me just close this. Any question? Wild?
Okay. According to what you have said, I was just wanting to ask if the handling of the reference will increase the profit.
Pardon?
When you change the margin, will it increase the profits or just make the stop loss to get further?
When we add margin or when we DCA?
You DCA now. Okay.
I think I've explained that, but let me repeat again.
Both.
When you DCA, let me start again. Once you DCA, two things will happen. Number one, your entry price will go down. Your entry price will go down and also your margin will be added. Remember when you were practicing on DCA, you've seen that also a margin increased from $50 to $100. So the margin will also go up. But the most important part is that it will lower your liquidation price, but not that much. It will lower your liquidation price, but not that much. But on top of that, it will lower your entry price. So it makes sure that even this money that you've DCA'd it will be accounted for when calculating your profit. That's scenario number one. But scenario number two, when it comes to adding margin is solely to lower your liquidation price. That's the work of lowering your margin, of adding margin, to lower your liquidation. It will lower your liquidation, and in comparison to DCA, it lowers your liquidation very, very, very far. So it's very efficient. But your profit will only be calculated using the initial margin that you started with. In our scenario right here, it was $50. So that profit will only be determined by that $50. The extra $50 that we've added will not be accounted for, and it will only be used to lower our entry price. Or not our entry price, our liquidation price. Is that okay, Wild? Mula?
I was just having a thought. When you DCA on spot and on perpetual, spot, does it looks like spot is a better deal when you DCA?
Yes, with spot is a better deal, of course. Once you DCA with spot is definitely a better deal than with Binance. And with futures, when you add margin is more reasonable because your liquidation price will go all the way down.
Okay. But can you do both DCA and add margin on the same trade?
Yes, you can actually do that.
Okay.
Yes. Any other question? Let me see if there's something I've left out. I think we've done everything. Yes, I think we've done everything. So, okay, if no question, then I'll end this class at this part. If there's something you've not understood, the video will be up and you can always go through it at your own free time. Otherwise, guys, have a good night and God bless you. Bye-bye.
Bonne nuit.